Hello, everyone, and welcome to today's webinar on risk responsibility and the path to scale for reforestation carbon credits. I'm Chris Field. I'm the director of the Stanford Woods Institute for the Environment, where we do interdisciplinary solution-focused work on oceans, climate, water, food, and biological diversity. One of our new initiatives is in natural climate solution, storing carbon to help address climate change. And in partnership with the Stanford Doerr School of Sustainability, Sustainability Accelerator, we've been undertaking an ambitious effort to understand what's working and especially what's not working in the carbon markets. And that's the topic of today's webinar. The plan is that we'll overview a new report, shared exposure, scattered responsibility. Then we'll turn the topic over to a conversation with three experts in the carbon markets for their perspectives on what we've learned and what we need to learn, what the next steps are. And then we'll open the conversation to all of you. And if you are interested in entering a question, enter it into the Q&A box at the bottom of your screen. We'll get to as many questions as we can. At this point, I want to turn the conversation over to Dr. Connor Nolan, a research scientist in the Woods Institute, who led this work on risk, responsibility, and the path to scale. Connor.
Hi, everyone. Thank you so much. Thank you, Chris. And thanks, everyone, for being here. I'm really excited to talk about some of our new work on shared exposure, scattered responsibility, how uncertainty about risks and risk responsibility is holding back the reforestation carbon market. I'd like to thank my co-authors here, and I'd like to thank the Sustainability Accelerator. The full report is available online at go2.stanford.edu/reforestation risk. So we know there's billions of tons of potential that reforestation can contribute to climate change mitigation, and we've known this for a really long time, more than 30 years. But transaction volumes remain low in the low millions of tons per year, with prices often in the $20 per ton range or lower. How can we help scale up this market? To get at that question, we worked with a market research firm to perform parallel online surveys to understand risk perception and risk responsibility in the reforestation carbon market. We surveyed 100 project developers and carbon market professionals representing the supply side, and we surveyed 100 corporate carbon credit buyers representing the demand side. Our top line takeaway is that buyers and sellers in this market see major alignment on price, with 55% of buyers suggesting their companies might be willing to spend $60 to $90 per ton more for nearly risk-free carbon credits, and 87% of developers thinking they can produce such credits at that price. But there are many risks and challenges associated with realizing this potential alignment. We summarize 8 key categories of risks facing these reforestation carbon credit projects. Things like delivery risk and reversal risk, quantification, political, claims, co-effects, how reforestation fits among the broader market landscape, and general reputational risk. We asked, how often do each of these risks reduce project investment or buyer demand? And we found there was limited alignment within each group and interesting patterns between groups. But all of the different risks received answers ranging all the way from rarely to regularly, all the way up to a pervasive influence on reducing project investment and buyer demand. We also asked who among buyers, developers, or a third party is primarily responsible for mitigating each risk. And again, we found limited agreement with all of the risks receiving significant amount of answers for each responsible potential party. And there was differences. We found responsibility generally flows outward, with demand putting more risk on developers, suppliers, seeking third-party and buyer solutions for managing risks. But really, we see a situation that for many risks, everyone is exposed to them at all different times. We asked what would help unlock growth, and we found that more offtake agreements and more early stage investment was needed from developer side, and for buyers, they were seeking greater transparency and lower perceived risks, along with insurance products and other issues as well. We end the report with some key action areas, including risk allocation, developing standardized frameworks, new risk transfer, formalized risk transfer approaches, more transparency, standardized offtake agreements, potentially some with early or milestone-based payments rather than pay on delivery only, more grants and loans to help with early funding to figure out project feasibility and build capacity, and greater standardization. The opportunity here is that alignment on risk and risk responsibility can help reduce market friction. It can help lead to prices that reflect real differences in quality and risk exposure. We can have more transactions at higher price points that are still a great deal relative to other carbon dioxide removal pathways. And we can have reforestation be a risk management model for the rest of the carbon dioxide removal industry. That was a brief overview of this report. Like I said, the full report is available online, and a longer academic write-up is going to be available soon. I'm really excited to this over back to Chris and the rest of our panel to hear this great conversation. Thank you.
Thank you, Connor, for a really good overview. And if we're going to dive to the next stages of understanding this issue, what we really want to see is what are the perspectives of the project developers? What are the perspectives of the buyers? And what are the perspectives of the intermediates that are intended to reduce friction in these markets? So I'm thrilled to be joined by three experts representing those perspectives. They are Racheal Notto, who's the head of carbon markets at Kita, a carbon insurance specialist. Kita provides insurance options for carbon markets spanning a variety of risks and covering nearly all entity types. Her focus is on macro trends in carbon markets to ensure Kita's solutions are fit for purpose. Second, we've got Miguel Moraes, project director at re.green. Miguel's a biologist with background in biodiversity and a PhD in public policies and sustainability. re.green is a developer focused on landscape restoration projects in the Brazilian Amazon and the Atlantic forest. And then finally, we have Julia Strong, founder and executive director at Symbiosis Coalition. Symbiosis Coalition, it's a coalition of buyers committed to catalyzing the next generation of nature-based carbon removal projects via an advance in market commitment to contract for more than 20 million tons of high-integrity nature-based carbon removal by 2030. And I'll start with questions to Julia. After we cover the topic of what's your favorite tree, I want to get your sense of what you feel is holding back the carbon markets really generally and looking at the results of the survey that Connor just described.
Great. Well, Chris, I don't think I got to hear your favorite tree yet, so we'll try to weave that into the conversation.
I'll get to it, I promise.
Well, thank you so much to Stanford Woods Institute for convening this conversation. It's great to be here among colleagues, among folks in academia and industry. As Chris mentioned, my name is Julia Strong, founder and executive director of Symbiosis Coalition. And we, as Symbiosis Coalition, were founded to address some of the challenges that were holding back the reforestation sector to help address the climate challenge and help buyers and the different actors to meet their climate goals. Well, some of the challenges that we saw were things like uncertainty about demand. What do buyers want? And are buyers willing to enter into the long-term agreements that are critical for de-risking these projects that investors need to see to unlock lower cost financing needed for scale? So that uncertainty about demand was a critical challenge and remains to be a critical challenge. Uncertainty about what good looks like. So what do buyers want to see? What does the science say is the best in class projects that lead to conservative carbon accounting and clear climate outcomes that really integrate and benefit local communities and people, and that lead to high integrity ecological outcomes. And so, with confusion about what good looks like, buyers are unsure of what to buy, developers are unsure of what projects to develop, and there's concerns about the risks of getting involved in a market in the market. So, Symbiosis Coalition was really aimed to launch with a clear action-oriented offtake commitment to help give a clear demand signal, to say that there are buyers who are committed to quality, who are willing to send a demand and then follow that with the long-term offtake agreements that are needed to de-risk these projects, and send a clear signal on quality, that buyers are looking for projects that represent the latest standards, the latest science, that take a conservative approach to carbon accounting, and to ensuring that all stakeholders are engaged in an equitable way, and ensuring that there are high integrity ecological outcomes and transparency, as your report highlighted, into what is the impact that these projects are actually having on the ground, and can we measure and quantify and track that impact over time and ensure that these projects lead to a durable outcome. So some of the things that are holding back the market would be more demand, more certainty of that, so more offtake agreements as you've unlocked. And what we're trying to solve is symbiosis, more clarity on quality and a clear standards on quality, which we're also trying to contribute to with the ecosystem. I think the last thing I'll just add before handing it over to others is this point about earlier stage support of projects. There's a lot of promising potential out there, but the need for support to get more projects to the stage where they're ready to sign offtake agreements, these long-term agreements. And so that need for earlier project investment, financing to bridge the gap to get to the point where projects are ready to sign these offtake agreements, and unlock project scale financing is another area that I think would be really catalytic to helping to scale the market.
Thanks so much. And Julia told me earlier that her favorite tree is the dogwood, and I will allow at this point that my favorite trees are California coast redwoods, which, in addition to being some of the most spectacular ecosystems anywhere, have some of the highest primary production and wood addition rates of any forest ecosystems. And I'm not advocating them for carbon markets, but it's worth looking at. And now to Miguel, after the favorite tree part, I'd be really curious from the buyer perspective what you see as holding the markets back, and in particular, whether it's actual technical problems or more problems of perception of problems in the market.
Great. Thank you, Chris. It's a pleasure to be here with my colleagues from the removal market. I'm very honored to participate in this important webinar. Well, I must say I have worked for the last 15 years with ecological restoration, and I think basically in the third sector, and I think I've struggled with the question on how to scale up nature-based solutions. It's actually a question of how to tap in commercial capital. And I think that in the beginning, I had the impression that the cost-intensive profile of restoration projects were in the way. I believe that was the problem. But then I realized that, capital demand is also an opportunity for the finance sector. So that's not actually what was going on, right? If we have investors willing to occupy that space, that wouldn't be the problem. So I realized it could be the return. But then, when we started to work into the finance models, not only re.green is occupying that space, but other developers are working with nature-based solutions. All of them have business models that already offer competitive returns, two-digit returns. So that's not the issue, right? That's not preventing a bigger flow of private commercial capital. So we realized that perception of risk of different players is an issue. So I think most of the friction we have comes from this perception of risk and the variability on how these different actors and stakeholders understand those risks, not only in terms of probability and the impact of those risks, but also in terms of attribution and allocation or ownership of those risks, as you guys mentioned. But I also would like to comment that I think that perception of risk is also intimate related to the perception of value. And the perception of value of what we are doing is dependent on how we understand the claim that underpins that specific asset that we're trading, right? So understanding the claim is really important. And the reason I'm saying this is because I believe there are many misconceptions about the role of nature in the climate crisis. And not everybody understands the same way what is being proposed in terms of project design. So I believe if we understand the essence of those claims better, we can standardize that risk perception and that ownership, and we're going to be able to reduce friction.
Excellent. Hey, can I do a quick follow-up? When you say the risk perception, are you saying primarily that there are important risks that are not managed, or that the perception of the risk doesn't align with the reality of their magnitude?
I think they do not align with the reality of the magnitude. I think we have a little bit of both, but I think that many times, for example, the way we value permanence and durability within carbon removal market, for example, is not equivalent in my understanding on how we have impermanence in natural cycles. So understanding what's the role of that activity and what's the claim behind that carbon that was removed is important when it comes to value. It's important when it comes to risks.
Okay. Yeah, thanks so much. And Rachel, your enterprise is specifically designed to manage some of these risks. Can you tell us a little bit about how you see it contributing to overall risk reduction in the carbon markets and overall friction reduction?
Yeah, so for insurance as a tool to the carbon market, just a little history too, is obviously insurance broadly has been around for centuries. Most people interact with it every day. But in terms of insurance in the carbon markets, that's been fully available for about 3 years now. So up and running solution, but also a newer solution to the voluntary carbon market. And I think insurance, in terms of reducing friction points, actually kind of comes back to a lot of what Miguel and Julie have been talking about in the headline of the report, is that there's quite a lot of disagreement regarding who's responsible for risk mitigation and remedying if the risk is realized, depending on what the specific risk factor is. So I think insurance can be really great to help with that conversation, because when you're going through and getting an insurance policy, regardless of what type it is, there's a single named insured. So at the end of the day, whoever's the named insured, like that's the one that goes on the policy, which also means that that's the entity that's really best placed to absorb that liability that comes with the risk factor. And this can be really interesting when you're having conversations about it in the carbon markets, because from my perspective, historically, a lot of risk has been pushed onto project developers where they have to absorb it either through risk mitigation or remedying if any risk is realized. And that is still, I believe, a little bit pervasive in the markets today. But one of the key elements that we really hear about, whether it's like delivery risk or permanence risk as well, is the project developer like really the best one to hold it? Just as examples, because in the insurance industry, there's this concept of moral hazard. So you can't get insurance for you doing the bad thing, essentially. And when we talk about both delivery risk and non-permanence risk, there are elements that are within the control of the project developer, and then there are elements that are not within the control of the project developer. The elements that are not within the control of the project developer are the ones that the project developer could be insured for. But if you had a different entity like the carbon standard or the buyer as the insured, again using delivery and non-permanence risk as examples, then like the insurance policy can cover all of the potential causes for non-delivery or under-delivery or for a non-permanence risk being realized. So that step removed, I think, really helps that conversation within the voluntary carbon market, where insurance helps move things along in terms of like who really is the best entity to absorb the risk.
So to make sure I understand this, what you're saying is that at the side of the project developer, there are some kinds of risks you could insure and many you can't. But if you were to provide a policy to the buyer, some of the things you couldn't insure with the developer, you could insure for the buyer.
Yes, yes, absolutely. And just to like give an even neater, simple example, we just think about non-permanent risk. There's the general categories of avoidable reversals and unavoidable reversals. If the project developer was the insured, they would only be insured for the unavoidable reversal causes because those are the ones the project developer doesn't have control over. Again, can't be insured for you doing the bad thing. I also want to say bad thing doesn't necessarily mean bad faith actor. Bad things happen to good people all the time. Versus if it's on the demand side or the standard side, those causes of avoidable and unavoidable reversals, the actor's one step removed.
Thanks so much. And so let me continue this theme of how to think about the risks. And Julia, one of my friends on the buyer side, always says that his big concern is that we tend to have a paradigm that leaves much of the risk with the atmosphere or the climate system. And that what we're really trying to do is get into an environment where that doesn't happen. And how do you think about the steps that get us toward that ultimate goal?
Yeah, I think, Chris, that speaks to having clear standards and clear quality criteria that's based in science, that sort of walks the line between what does the science say is needed to help have confidence in the outcomes, but also what's implementable and feasible on the ground. I think that's like some of the tension there. You want to have quality criteria that's actually first and foremost grounded in what can we have confidence in the certainty of climate impact, and then how translating that into then how do you actually understand and diligence and evaluate how to assess whether a project will have its intended impact. And there's in the carbon market, there are buyers who are looking at spot credits, which are ex post credits, which you can see, okay, the project's already happening. I can quantify and see what's the actual impact. Are the trees there on the ground? Is the project implementing in the way that they said they would? Then there, according to this methodology, then there's offtake agreements, which are looking at projects ex ante, where the project may have a pilot in place, they may have some amount of implementation, but you're really entering into an agreement and a commitment to deliver projects in the tons in the future. And so you're making an assessment of what's the likelihood that this project will actually deliver the quality of tons that I need as a buyer to make my public commitment. And is that the volume and the quality of the tons that I need, and on time, right? Because a lot of these buyers are putting commitments out there to say we're going to be a net zero by 2030, and we're each year after that, we'll be making sure we're making claims that are associated with the retiring of these credits. And so, in terms of making sure that the projects are set up for success, that the likelihood of the impact is most likely to materialize, buyers undergo a rigorous diligence process. And so one of the things that Symbiosis is trying to do is to help streamline that process for developers, for buyers, to make it easier, and make it have more replicable so that developers understand how are risks being assessed consistently for projects. How are we evaluating all the different dimensions of risk that you highlighted? What are the different opportunities to mitigate those risks through structural design, through redesign tweaks, and then what are the opportunities to mitigate those risks through contractual terms or clauses? And we are also, as Symbiosis, have put out offtake guidance that you can see on our website that sort of outlines how we're trying to help to standardize offtake agreements to clarify, how we're approaching these. How mitigating risks, and in these offtakes, and also through our diligence. So I would just say that Ultimately, we need to make sure that we have the certainty of climate impact, that we know that if we're these projects that are committing to deliver tons over the course of 10 years or longer will actually materialize with the amount of climate impact and the quality of climate impact. Then we need those clear standards. We need rigorous diligence that identifies those risks, and then different mechanisms, whether that's through project design, through offtake agreements, or through other mechanisms like insurance to ensure that ultimately the impact that we want to see happening is materializing.
And Julia, you make the case, and I think it's very clear that Symbiosis wants to focus on buyers at the high integrity end of the markets. And do you see good evidence that this focus on high integrity is raising the overall level of ambitious among participants in the voluntary carbon markets, and that more and more are interested in adopting the kind of standards that are necessary?
I think so. I mean, one of the things since my time in the carbon market is that there's a clear convergence, increasing convergence around what good looks like the adoption of dynamic baselines, increasingly engaging stakeholders and local communities and indigenous peoples from design all the way through implementation isn't a co-benefit. It's actually like a core driver of project impact, because if you don't have people engaged and equitably compensated, the project's not going to last. So it's not going to be a durable, lasting project. And for there's been scrutiny in the market, which has changed the dynamic so that many buyers see that the risk of action is higher than the risk of inaction, which is complete opposite of what we want to be doing. We want to be encouraging more impact in the space. And so buyers who are acting are very much dedicated to and ensuring that the projects that they're purchasing from represent the latest standards, the best in class science. And that's hopefully what Symbiosis is helping to do, is to give buyers that confidence and clarify for developers what buyers are looking for in the projects that they're committing to and that they're purchasing from. So I definitely see that. Generally, when you see buyers in the space, they're using removals as a complement to internal decarbonization as part of a suite of the tools in their climate toolkit. But first and foremost, focus on decarbonization, and then secondly, making sure that their projects, as much as possible, are representing these latest standards, best in class science, and trying to ensure that those risks are mitigated so that when the claims that they make are ones that represent real impact and certainty of impact in the atmosphere.
Thanks. Just a quick reminder to folks in the audience that if you would like to have a question, get into the queue, use the Q&A box at the bottom of your screen, and we'll get to as many questions as we can. Miguel, you talked about this sort of two-sided problem with challenges in getting finance for the really good projects, but also the perception of risks as not being fully consistent with the actual risks are. And what do you see as next steps for getting us out of that so that more finance flows and that the understanding of the risks is more aligned with what they actually are?
Good question, Chris. I think that we're starting to generate a lot of sound data on the actual project implementation, and we are learning a lot with that. And I think that that's impacting our own understanding on project design and implementation and the actual challenges. So we are learning a lot now with these first cycles of issuance. When re.green started to work, we decided to jump into operations right away because we wanted to prove a concept and show that large-scale restoration was possible, was effective, was a good solution. So we jumped directly to operation. Then we closed a commercial deal. And then we went to the finance sector trying to raise the capital to implement all of that. I would say we would need to shift it around. And actually, the ideal would be to have secure finance, then to have a commercial deal established and closed, then to be able to go there and implement the project, right? That would be like the ideal scenario to us, let's say. But I think that's not happening. That's not happening because the finance sector, I think, still see nature-based solutions as risky investments. So how can we help the finance sector to adjust a little bit their perception of risks and understand what is here at stake and how the projects that are being developed following those high quality standards are actually addressing those risks. I think here is one important issue. Now, we talk to other rating companies, to other developers, to investors, and sometimes we see risk assessments that are actually assessing the risk of the context where the project is being implemented, not looking how the project is addressing those risks. So you end up with a perception of risk that is much more at the landscape level than actually the residual risk after all the efforts that the project's undertaking to address those risks, you know? And I think that is a problem because you end up with the same perception of risk. Let's say no one is doing projects in the Brazilian Amazon because of the social conflicts, the risk of deforestation, climate change, and all of that. You know, it's really harder to make a project stand in that context. So I think we need to adjust those risk assessment frameworks to make sure that we are looking into the residual risk rather than contextual risk by itself, you know. And I think that universities and research centers can help us a lot because at the end here, I think we need to reconcile economy and ecology in a sense and bring those two together again so we can have a better understanding of the risks.
Great. Your characterization of the ideal financing model sounds to me quite a lot like the venture model in tech. And do you see something like the emergence of a venture capital industry for natural climate solutions as a possible next step?
As a possible next step, yes, but I don't see the speed that we need actually in place. We see a very slow movement on that upfront capital mobilization. We are still having to search for other solutions and not being able to access the best capital to this specific moment of project implementation. So potential, yes, but I don't see that as a short-term reality.
Julia, did you want to jump in?
Yeah, I'll just jump in and say one of the sort of areas that we're sort of aiming for as Symbiosis is thinking about, we maybe less venture capital and more like infrastructure finance, right? These are large scale projects. We want to be creating an ecosystem where projects can be accessing low cost debt financing to really get to the scale of implementation and the lower cost financing that's needed for scale. And so one of the analogies I like to use is what Symbiosis is trying to do, and Miguel, building on what you shared around what's the right order of operations, how do we get all these pieces of the puzzle working together, is Symbiosis hopefully will be through bankable offtake agreements with creditworthy buyers do for the nature-based carbon removal what power purchase agreements did for the renewable energy sector in terms of unlocking billions of dollars of investment and de-risking these projects to help to unlock the scale of investment and long-term investment that's needed, right? That we need longer-term capital at lower cost. Right now, to I think Miguel's point, like these are perceived as risky investments for investors, but the more we have proof points of projects that are successfully delivering on time and at the volumes that are needed, that are signing these long-term offtake agreements where these agreements are standardized, and it's clear, how to investors, what's the obligations of buyers and developers, et cetera. I think we will be able to unlock that institutional scale capital that's needed. And we speak to investors who are excited and interested in this space and see that there's the potential there, but those different pieces of the puzzle need to be put into place to give them the confidence and ability to underwrite these projects at the scale that's needed. And there are, investors who've worked in emerging markets and in in agriculture and other contexts like, that have similarities, but at the end of the day, tons of carbon are not electrons. So there are some distinct differences that we need to manage in the carbon market. But I'm optimistic that through the work of leading project developers and through works like Symbiosis and other innovative mechanisms like insurance, we can get to that future state.
And jumping in on that really
Briefly.
quickly too, I just
Oh,
wanted
go
to
ahead.
confirm what Miguel and Julia are saying, that next wave of financing structures is already underway in the carbon markets. Specifically what Julia is saying on the bankability of the offtake structures and what banks are looking for to be able to provide more of that debt financing. Outside of the carbon markets, one of the questions banks will ask themselves is non-payment insurance available? That is a requirement for them to be able to sign off for this type of debt financing. And non-payment insurance is insurance for banks to be able to get back essentially the loan amount that they put if the person or the entity that the money was loaned to cannot pay back their debt. So Kita has brought into market a non-payment insurance policy, which specifically helps in addition to what Julia was saying around the different offtake structures and looking at it from an infrastructure perspective, being able to pull in those larger institutional funds, essentially.
Yeah. Rachel, for the folks who aren't experts in the audience, could you just explain what a bankable offtake agreement is?
Yeah, so essentially it is looking at the literally a bank that is deciding to be able to provide this debt financing to a project developer or whoever they're doing the lending to. Is that something that they can balance out when they're doing their cost benefit analysis to understand if they're going to get a good return on investment for sending out that debt? It's all about the confidence really when it comes to the bankability of that agreement. That's like in the most simplest terms.
Great, thank you. And Rachel, when you look across the list of risk areas that were evaluated in the survey that Connor described, uh, are there some that you see as particularly problematic that we don't yet have a philosophy for dealing with? Or if we're thoughtful about the risk management structures, like the insurance that Kita provides, can we basically address all of the risks?
That's a good question. I think we could basically address all the risks. I don't think there's any risks missing in the profile when we're talking in terms of the report or across the voluntary carbon market. I think if someone thinks a risk is missing, then it could be more of an indication of lack of understanding because there's so many risks that we throw into a really large umbrella like non-permanence risk. But under that, there's a million different ways that a reversal could be realized, and each of those would be individual sub-risk categories. So I think we definitely cover all the risks. It's about discussing it in a specific context of the project or the contract or the financing that's looking to go through. I think also a lot of it too, going back to what Miguel was saying earlier, is understanding the real potential magnitude of the risk. I think this kind of, for me, ties back to the charts that were presented in the beginning, where it looks like it's all of the risks all of the time when you come at it from a perception basis, but that's not necessarily true. And that's where data plays a really important part to be able to have a more fine-tooth comb that says this is the actual risk profile based on the data, not based on the perception. And I think the data availability and how that funnels into risk profiling and analysis is really important. Obviously, in the voluntary carbon markets, data has been a huge problem historically because data siloed is all in different formats. Not all the pieces are fully available. A lot of it is just that like it's locked up in PDFs, which are not great places for data to be if you want to do anything with it. The BCM over the last few years has been doing incredible work at both individual and central levels to progress data availability and transparency and usability. But also one of the benefits for an insurance company is insurance companies, they're just a pile of data analyzing it every which way. So the insurance industry, separate from the carbon markets, has a lot of really huge data buckets that we can pull from. I mean, a great example is natural catastrophe and climate change modeling. Like insurance industries, they have huge models that go back long decades, centuries in terms of basically as long as that data is available, it exists somewhere in the insurance industry in terms of those large modeling capabilities.
And your sense is that the data are out there in some sense, and that if we could get them in a sufficiently organized form, then insurers could figure out the actuarial steps necessary for pricing them accurately.
Yes, I think just to be clear, we are all moving in that direction already. The VCM specifically over the years has done a lot of work in terms of increasing data transparency, availability, and usability. I think CDOP is one of the entities that's doing a lot of work on that side, central to the VCM. The insurance industry has a lot of data. That is one of those things where kind of it sits behind a private wall. So having the right inroads to the insurance industry to be able to integrate it with the carbon market data, which is a lot of what KETA does. And then there's always going to be those elements where the data is just missing. So you have to find good proxies or create good benchmarks that generally everyone agrees for that specific use case too.
Yeah, thanks so much. Um, there are now a bunch of terrific questions in the Q&A box, and I want to get to those, but I also want to bring Connor back into the conversation. And I wonder, Connor, if you would like to just comment as we transition from this part of the conversation to the Q&A. What was the biggest surprise in the survey results for you, and what are the implications of that surprise?
I think the biggest thing that I was surprised by was that there was just such a wide range on all of the different risks. I think going in, we were maybe interested or hypothesizing that there might be some risk where the developers viewed them as more important, and some risks that there was a mismatch between developers and buyers. But what ended up feeling like we were seeing more was just that there was just this like disagreement across the risk, which this means like there's a lot of uncertainty and friction, which is one of the biggest blockers in terms of scaling up a market. That like if we talking to people over the business school, that uncertainty is the biggest thing that is blocking a lot of investment, I think, in general. So I think we were surprised that it was like there was such a big range across all of these different risks.
But I think also a surprising overlap between the prices that developers thought they needed to charge and the prices that buyers were willing to pay for uh, risk managed carbon markets.
Totally. I think that was also really exciting and surprising, and kind of suggested to me like there's real potential here if we can start to get better alignment, where we could do a lot more. There's a big difference between a $10 or $20 per ton reforestation project and a $50 or $60 per ton, I think. So it was exciting that there's at least some signs that there might be interest in working at these higher prices, where you can do more sophisticated risk management and more sophisticated, community engagement and
Yeah,
things like
I
that.
totally agree that it's super interesting to see this convergence. Let me turn now to questions in the Q&A. And the first is from Jackie Lundy. How do you see agriculture fitting into the carbon markets, in particular orchards? Anyone who wants to tackle that one? Julia, from a buyer perspective?
Sure. So with any project type, we're looking at what is the technical readiness, what is the scientific readiness, for what are the methodologies or mechanisms in place to quantify and transact, and what are the project developers who are actively developing those projects or in the process of getting those projects off the ground. There are soil carbon projects in the market, and Symbiosis hasn't yet tackled soil carbon, but there are projects that are looking to quantify the carbon in soils, and that are already starting to deliver carbon for those projects. With any project and type, there are different archetypes within it. Like even within reforestation, we think about conservation-oriented reforestation versus reforestation efforts that integrate working forests and timber production. And each of them, to Miguel's earlier point, like the project context matters a ton in understanding and evaluating the risks, the approach that the developer is chosen, and its suitability for the particular social, economic, ecological context matters a lot. I would have questions around, for any project type, around how do you assess the additionality? What's the data available to quantify the climate impact, and what does the science say about is there scientific consensus around how you measure and quantify the carbon sequestration, and monitor that over time. So agriculture is definitely an area of interest in the nature-based solutions market. Symbiosis isn't tackling that, but there are buyers out there who are engaging in that part of the market.
Chris, can I also make a quick comment on this one real
Go
quick?
ahead, Miguel.
Yeah, I think that carbon removal is all about establishing a resilient landscape, a more resilient landscape. We cannot just focus on the actual result and removing and sequestrating, because all the climate models that we use, they consider a basic assumption, functional ecosystems, right? So being able to establish those functional landscapes is super important. And in that sense, social engagement and creating a social network that supports that transition at the landscape level is super important. So genetic material is definitely a bottleneck. We need seeds, we need seedlings. So this is also an opportunity to work with those communities around your project, engage those communities in activities that helps to value the standing forest. Because at the long run, if we are not able to establish economic activities that can support their own livelihoods, their forest livelihood, we're going to have a problem. We're probably going back to the transition that we don't want at the landscape level. So here, not only in the agriculture, but also in forest management, right? And engaging those communities to actually use that forest in a different sense, producing seeds and seedlings, high quality genetic material at scale is super important. So it's definitely an opportunity, and we're really concerned of that social network that needs to be established to ensure the long-term permanence of the projects.
Great, thanks. Let me turn to a question that's probably for Racheal. This one's from John Walton. Both buyers and developers pointed to third-party risk transfer mechanisms. Do you see opportunities for pooled insurance or shared risk facilities specifically for nature-based carbon, as has been done in the disaster risk management sector?
Absolutely. I think there's a lot of different ways you can slice that, honestly. And a couple of approaches that Kita is already working on that answer that question directly is Kita does provide buffer insurance, so ensuring the buffer that's run by the carbon standard. So that's already taking a pooled risk mitigation solution and providing insurance behind it to help with the backstop to it. Another element that Kita is working on with American Forest Foundation, who's another project developer in the US, and is the concept of a permanence trust. So essentially using a fund-based approach similar to an endowment fund like a university or a pension fund like what a government would run, and taking that fund-based approach to help cover the long-term risk related to non-permanence risks. So I think that's definitely true that we can use other solutions. Some of them are starting to come into the VCM, And the more that we can bring in where we're borrowing from solutions that exist just from other markets, I think the better that is for the VCM because then you have tangible examples to point to that build trust in the proposed solution. And trust is key when we're trying to do anything any day. So yeah, I see those as great examples to further pull into the voluntary carbon market.
Oh, Chris, you're muted.
Sorry, I was going to sneeze, so I muted rapidly. Let me turn to a question that's probably for Miguel. Um, how do you overcome the risk of land rights, particularly in emerging markets like Brazil, where the regulatory landscape can be tricky to navigate? For example, how do you overcome the risk of zoning changes, ability to reclaim land should there be a bankruptcy?
That's a good question. And if you have the answer, I would like to know and write it down because I think that's the 1 million question. To be really honest, I think that translates into delivery risk because at practical terms, what happens is that we slow down our land pipeline. So we expect to be able to accelerate project implementation, but our land pipeline is really slower than what we would like, you know? So that what happens. If we try to invest and put a lot of efforts to accelerate that process, it's not effective. We end up like spending money with something that is not that effective, meaning that the success turnover point of our land pipeline is lower than what we would like. This is really a bottleneck, and we would need to work together, I think, to help to de-risk a little bit that context, you know?
Great,
I
thanks.
can jump in on that one as well, just to kind of elaborate it from a different perspective. I think everything that Miguel said, looking at it from the delivery risk angle, is absolutely true. Another angle to consider it from is the political risk angle as well. Political risk insurance is something not unique to the carbon markets. It's one that's been available and can be used across all different types of markets. But from Kita's perspective, in addition to the delivery component, a lot of those land rights and carbon rights issues can also relate to the political risk elements, exactly as posed in the question around zoning changes, but really more broadly, like governments, they have the will and the power to legislate and rule because it's their country. So the political risk element is also one, and I think the key here too is like all risks, but especially when it comes to carbon rights and land rights, you can't reduce that risk to zero. It's about making sure it's at a level that you clearly understand what that risk level is, and that level sits below what you're comfortable with. So I think that's another key element that's not discussed enough is if you're engaging in any market, you need to know what your risk tolerance is and only go into deals that fit that and use the solutions that bring the risk levels down into your where you're tolerating it to.
Excellent, thank you. Here's a question from Kaustuv Archeria. Maybe this one's for Julia. Is there any blended financing options that can help finance NBS carbon projects? Would it realistically reduce risk for both the developer and the buyer?
So one of the things that I think there's definitely opportunity for is earlier stage financing and philanthropic capital or catalytic capital to support get projects to get to the point where they can be offtake ready, so have the degree of commercial readiness and technical readiness that's needed to enter into these long-term offtake agreements where there's a high enough certainty on the ability for the developer to deliver the quality of tons on the timeline and at the volume that's needed, and there's a role for loan guarantees or ways to help to de-risk the projects and to help to reduce the cost of capital in this earlier stage of the market. So roles for catalytic capital and philanthropic capital to play in the earlier projects financing stage, and then also in the providing guarantees or loan guarantees to help to de-risk the project financing side of things as well. So definitely opportunity there. And this is a particularly catalytic time in the market to, as we mentioned, one of the amazing things about a market is if we grow the market, then it can unlock billions and billions of dollars, but we need to get those sort of proof of concepts and examples out there so that to give the confidence and the repetition, the pattern recognition that investors need to deploy lots of capital at scale. I think that there is really big opportunity for philanthropy and for catalytic capital to play in helping to get past this like growing growing pains in the market.
I think we have time for maybe one more quick question and then a closing thought from each of you. Here's a question that's probably for Racheal. These projects seem inherently more international in flavor than offtakes supporting electrical infrastructure, which is often regional or domestic. How do you think about risk in terms of international policies and relations?
That's a really good question. I think within the voluntary carbon market, it's going to cover the entire range from what is happening regionally, directly on the project, all the way up to the international level. Just using like examples, natural catastrophe, the climate change, like that's going to be very specific to the location of the project. But in terms of on the international policy side, that's actually a lot of what my day-to-day is in terms of responding to public policy consultations that influence the carbon market. So a couple that are top of mind right now, just as examples, is the European Union's CRCF, carbon removals and carbon farming. They're working on getting that up and running over there, and they just had a consultation call for input. Specifically, one of the elements in it was around liability mechanisms that were allowed for risk mitigation and remedy related to non-permanence risk. And as originally written, it essentially only allowed buffer pools to be used, but it did state buffer pools could be operated by entities other than carbon standards, which is interesting. But that's a great example where a public consultation was put out around liability mechanisms. The voice of the people and the market actors needs to speak up when they know these opportunities exist to say, well, think about all these other tools and solutions that could be used. And I think that the other key thing too in the policy framing is that it's not a one solution, one size fits all approach. It's all solutions. And depending on which tools you use is going to be specific to that exact project, that exact offtake agreement, that exact scenario that you're trying to work through. So that's a really great example on the one side. And I think another one, too, is with the Paris Agreement crediting mechanism. Again, just sticking with the non-permanence risk example, but the Paris Agreement crediting mechanism is working through right now how they're going to measure reversal risk. And originally, towards the end of last year, the version that was put out was quite restrictive and in practice would have really limited the eligibility of nature-based solutions under PACM. There was huge outcry from the public that that was not the way to go. And under the Paris Agreement crediting mechanism, work is now continuing to be done for that reversal risk tool assessment, which lines into the non-permanence risk area. And that's an interesting area to watch specifically because the Paris Agreement crediting mechanism will impact the voluntary carbon standards at least over the next few years too. I'm sure it'll have influence on compliance markets as well in terms of compliance markets that are new and emerging borrowing from PACM. But yeah, PACM's a really interesting space to watch as well from a policy perspective.
Yeah, excellent. Thanks so much. And thanks to everybody who put questions in the Q&A box and incredible range of sophisticated things that people are asking about. We're just at the end of the hour. I want to thank Julia and Racheal and Miguel for a series of really spectacular and insightful questions. And I want to turn it back to Connor for a closing thought on what we've learned and what we need to do next.
Thank you, Chris, and thank you so much to all the panelists. This was really great conversation. I love having the chance to bring together all, the buyer, developer, and kind of market intermediary voices into one conversation. I hope this is just the beginning of a conversation. And I think it's fun to be in this kind of academia role, especially in the Woods Institute and the Doerr School of Sustainability, where we are really thinking about how can we support scaling up these markets? How can we help make sure that there's a role for nature in the carbon markets, and we can make sure that nature-based carbon solutions like fulfill the promise that they have in terms of both, like having conservation co-benefits, having sustainable development and community co-benefits, and making sure that the atmospheric carbon actually goes down. So I think doing these kind of risk management talks and getting into the details like has really helped set the framework to keep building a really great market system. And I hope it's just the beginning of a series of conversations.
Thank you, Connor. Thanks, Julia. Thanks, Rachel. Thanks, Miguel. Thanks to everybody in the audience. And thank you to our tech backup, Celia Price and Evan Schwartz. This has been a really wonderful conversation, and I'll just close with the thought that Connor left you with, is that there's a gigantic opportunity to utilize nature for the benefit of climate, and we're going to make progress on it together. Thanks, everyone, for joining.